Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Bill Lee, chief economist at the Milken Institute, who is in Singapore for the 11th annual Milken Institute Asia Summit. Bill, always a pleasure to have you with us on the program. Lots to talk about this morning. We can talk about China. We can talk about the U.S. We can talk about U.S., China, and the Fed. Let's start off with the Fed. I'm curious why you think this time the Fed decided to not be very clear about its course of action. Generally, the market tends to know what the Fed is going to do when we get to the day. Not this time. Why?
Under Chair Powell, I think we've noticed that the Fed has really held its cards very close to the chest, and they're maximize the amount of optionality they have by saying that we're completely data dependent and we're going to look at the last bit of data before we make up our minds. In a way, it's done a disservice to financial markets. When I was at the Fed Reserve in the old days, there's a sense that we understood how the Fed worked. We understood its framework. We can anticipate its decision making. And I must say a criticism of the current Fed is this complete data dependency without telling markets what exactly it's going to do with the data. And I think that has been characteristic of Chair Powell's caution and wanting to preserve his legacy of sticking the soft landing and being one of the few Fed chairmen who's able to do that.
Bill, we've been talking about this debate in the marketplace, whether it's going to be a 25 basis point rate cut or a 50 basis point rate cut. Would you care to weigh in?
Well, let me just bring out the old school model of how the Federal Reserve has always worked and really continues to work at its core, which is to say they really want to make a path that's clear to financial markets that we are going to get back to neutrality. I personally believe that we should do it fairly quickly because the economy has been cruising at a steady pace and a very strong steady pace with inflation clearly coming down. But we're so far away from a neutral interest rate that we should just get on with it because there isn't a lot of danger of inflation resurging. And the weakening economy has got financial markets concerned. And I think Chair Powell should do a better job of explaining to financial markets there's nothing to be concerned about. The U.S. economy is on cruise control, and we're in fact, better than normal right now. The labor market really shows no signs of weakness at all, regardless of whether people believe this so-called Psalm rule or not. Normal payroll increases are like 150,000.
We're a little crimped on time today, so let's kind of have a little rapid fire action here. Let me ask you, we usually have unanimous votes there. Do you expect a lot more divergence or dissent in this decision?
I think the current Fed really is wanting to show a sign of unity, and that's why Chair Powell has been so cautious in telling markets what the Fed will be doing until it actually does it. So I doubt there's going to be much in the way of dissent.
So I'm imagining that China is going to be a big topic for the 11th annual Milken Institute Asia Summit. Are you concerned about the degree to which China is really stuck in this deflationary trap?
Absolutely. In fact, I've been in Korea at the World Knowledge Forum. I just came here, and the discussion is really all about China. And I've been telling everyone, China suffers some of the bad Ds, deficient demand, debilitating debt, and dismal demographics. And the debt's burden on local governments has really hindered the ability of the local governments to participate in the kind of fiscal policy that's needed to stimulate the economy. And Chairman Xi's aversion for direct transfers to households and keeping supply side measures going has really shown to be ineffective. And I hope they will see the light that the American and Western way of countercyclical fiscal policy is directly transferred to the households.
We imagine the Chinese economy to be stumbling a little bit now, but the U.S. economy to be in a good place. Meantime, China's actually growing faster than the U.S., even if it doesn't make the 5% target. Why?
Well, what's relative to normal, right? China's demographics has really slowed down to the point where normal growth to keep the population employed, it has to be above 5 to 7%. And now it looks like the every forecast is showing China to be below 5, except for the official one. So I think the measures of differences about normality and population and technology and productivity growth really explain most of the difference between the two growth rates.
Very quickly, Bill, in about 10 seconds, will we get something from the PBOC that is stimulative here in the near term?
That's not what they need. They need a fiscal policy, fiscal stimulus to support income and bolster wealth.
Bill Lee, chief economist at the Milken Institute in Singapore for the 11th annual Milken Institute Asia Summit.
David Finnerty from our Bloomberg Live team. So we're looking at the Fed. I'm wondering, David, whether or not you think that perhaps too much positivity has been priced into markets at the moment.
Yeah, well, in terms of you going whether it's 50 or 25, I think certainly at my end should be 25. I think the market is, as we've seen several times this year, is very biased towards rate cuts, and it is what it is. So if you give them any chance to price in 50, they'll certainly run with that. And I think reality is, if the Fed does cut 50, the markets could go, oh, you mean 50, 50, 50. So but reality is that's what it's going to do. It will try and price in. I think you'll be back to 6 rate cuts, 6 quarter point rate cuts this year. I mean, the market's going to go with it if you give it any chance. So I think I'm certainly in the 25 camp. And one of the logic is, I said, if you go 50, the market's going to go, because you remember back in the June dot plot was, the median forecast was for 1 rate cut this year. So suddenly you do 50 just 3 months later, it looks panicky. Yes, the data has slowed down. I get that, but I don't think the data warrants a 50. But if you give 50, the market's going to go, you're behind the curve. We're going to price in more rate cuts very quickly.
Yeah, the bond market certainly has done a lot of the heavy lifting lately, and that's one of the factors that has really kind of made financial conditions relatively easy. The other part of the story is the dollar and its relative weakness, and also higher stock prices. So do you think that the Fed would be right in erring on the conservative side?
For me, based off the data, if really the Fed's looking, look, we're here not to control stock market indirectly, you could say it is, but if it's looking here, we're trying to get that soft landing. I think the data for me warrants a 25, and then you can leave the door open to look, if the data weakens, then we can do 50. That's fine. But at the moment, I don't think, at 4.2% unemployment rate, yes, it's been upticking, but it did stabilise last month. So let's see if that uptick trend continues. I know the argument would be, if you leave it, you're behind the curve. But then again, are you going too aggressively too early? So for me, I think 25 is warranted.
I kind of think they'll go 50, but then we'll have more hawkish commentary than what some people might be expecting, just to give them, a very broad range of movement. Now you've got, a lot of room there in between the 50 and policymaker Powell, who's sounding like, this might be all you get for a while. So I don't know. I mean, we can muse about all of this. Your thoughts on whether the economy needs some juicing.
Well, at the moment, I think base is certainly slowing down. I think I'm in the 25 camp. I think the catch for the Fed, if you do 50 and go, and that's it, the market's going to go, no. You're 50, 50, 50. And that's what the market, the market is biased that way. So I think it's going to be very tough for the market the Fed to have credibility.
Well, David, they could do it. They could do it in a slightly different way. They could say, well, the Fed funds rate's at 5.5%, and they could kind of say, we think 50 basis points is a way to kind of bring that because inflation's down below 3%, right? So there's a really big gap. So they could say, well, 50 basis points is a first step. It's going to take some time for us to see how this works out. Don't expect too much in the short term.
I get you. I get your point, but then I'd say the market's going to hear what it wants to hear. Yeah. And the market's going to go 50, and I want 6 rate cuts this year. I want 6 quarter points, and you've opened the door to that, and I'm going to run with that. So it's the market interprets it how it wants to interpret, and it's very biased towards anything dovish. That's all I'm going to hear. I'll forget the rest. I'm just hearing the dovish part.
So you fear like a tantrum, and at this point, the Fed cannot afford to have the market not on its side. Is that fair?
I think it's tough to control the markets. Is that you've seen how much the market has whipsawed this year. Said go back to January with the 6 rate cuts, expecting 1 in March, then it went back to no rate cuts, and so the market continually shows its hand in terms of its behaviour. And I just think you've got to be careful what you ask for. In that the market is going to go very aggressively. If you give me signals of a rate cut, I will literally run with it. So I think 50 is the market's going, you're well behind the rate curve. We're going to put in 150 this year, and then let's not even get to next year, because we've got to do more next year. So I think yields get crashed and stuff. So I think it creates a mess for the Fed to try and control it. You've got like this kid who's running around. You're trying to control what it does on the leash, and the market's going, well, you give me a big leash to just do what I want, and I'm going to do
a leash.
I think the market's pretty. I think the market is pretty mature, and it seems like right now it's kind of understands that whether it's 25 or 50, it's the beginning of a cycle, and the cycle, there's no rush to do it, but you do have the election coming up, so maybe you act now and then see how things move over the next few months. I take your point that market can be kind of needy sometimes, but if you look at the market performance of late, it seems like even though we swung from 25 to 50, the market's kind of hanging in there.
Well, if you mean, which market do you mean? You mean the equities, certainly, because the equity market is going to love rate cuts, and understandably so. The bond market is certainly volatile. If you see the market's mature, I agree with you saying, but then you can go back to, well, hold it, just back in January, the market's going, I think there's 6 rate cuts warranted. And here we are later on. At the moment, we've had none. So yes, it is mature, but then it's shown a very strong bias towards a certain way. And that's what I'm just saying is, all I'm trying to say is, if you give that bias encouragement, it will run with it without question.
No doubt about that. I agree with that. And so talk to me a little bit about your expectations for how the dollar would react to the scenarios that we're laying out, 25, 50. What is the dollar reflecting right now?
Yeah, well, I think that's a good question, actually. I think the reality is, traders want to sell the dollar. So again, it's like they want rate cuts, and hedge funds want to sell the dollar if they can. So I think if you do 25 or 50, obviously if it's 50, then just sell the dollar. It's very simple as that. Because even if the dot plot is, say, on the more hawkish side, shall we say, the markets go, I don't care, it's 50, 50, 50, so sell the dollar. I think what happens is, if you get a 25, you obviously get a knee-jerk reaction. Dollar should theoretically go high initially, but then very quickly, it's like lots of headlines. You go, okay, that's initial. Then they'll very quickly look at what the dot plot does, and then you've got to go to what Powell says. And remember, it's a biasness in terms of, I want to hear something dovish, and if I see it, I'm going to run with it. So I think you'll get a little whipsaws with the market trying to sell the dollar if it's got a chance.
Yeah. We had Ray Dalio on earlier. He said 25 or 50, it doesn't matter. The U.S. economy is close to equilibrium. He wishes that policymakers would look at the big picture and the long-term picture rather than short-term considerations. Do you think there's any chance of that from the Fed, or can you expect it from the fiscal authorities?
No, I think it's a fair point. At the end of the day, you're supposed to look longer term. But again, the market thinks short term, if we're honest. So I think that one thing the Fed will go and it could point out, say, look, okay, where we do 25 or 50, the real question goes, where's the terminal rate going to be? And obviously that will have a better idea in that dot plot. So I think the Fed tries to go long term, but the market thinks short term, and that's all that most traders therefore care about.
For the record, I don't think the market's mature all the time. It just has sort of been behaving that way lately. There's plenty of times it can be pretty finicky, pretty panicky. David, thank you very much. David Finnerty, Bloomberg FX Rate Strategist. Paul Brody, global blockchain leader at EY. Paul is in Singapore for the Token 2049 Crypto Summit. I was just talking about the transition in part from retail customers to institutional customers and what one of the catalysts might be for that.
So the thing that we're seeing is what we're calling global regulatory convergence. And what's going on here is, as regulators have taken steps to bring crypto inside of legal frameworks, and we've seen that in Singapore, Japan, and across the European Union, as well as the ETFs, what's happened is we've shifted from this model where any consumer can do this, and their consumers were doing it, to one where things are now accessible by institutions. Pension funds, major sort of private investors, things like that. And so where the big money is, if you look at sort of the world's pools of capital, it's inside of institutions, and they can't touch cryptocurrencies or digital assets until they are regulated in these national ecosystems.
You know, it's interesting. There was a report that we were talking about last week where the FBI here in the U.S. disclosed that Americans lost a staggering $5.6 billion to cryptocurrency-related fraud in 2023. Talk to me a little bit about the public relations campaign that needs to take place, maybe to repair some of the reputational harm that the overall cryptocurrency space has suffered as of late.
So there is a huge amount of damage that's been done. And it's I used to joke that the special thing that crypto was good at giving to the people who hate crypto is ammunition. We are great at sort of providing frauds and cons and things like that. And I think what's happened, and I spoke to one European regulator, he put it very nicely. He said, the more we warned people against doing stuff, the more they did it. And we came to realize that the best path to improving the ecosystem was to regulate it and give people more confidence. And I do think that regulatory involvement has been a big catalyst to improving the perception of the industry.
Yeah, that's very interesting. It's something that a lot of people in their gut probably wouldn't feel is the case, that regulation can make a difference and actually broaden it. I'm curious, when we talk about that move from the retail customer to the institutional, does that also mean that the focus has changed a little bit away from cryptocurrencies and more to the blockchain?
A little bit, yes. I think one of the consensuses here at this event is that crypto is on a roll. It's going to grow substantially, but there's probably an upper limit on the size of the cryptocurrency industry. And it's probably roughly similar to what we have in gold today, which is something between $10 and $15 trillion, which, to give you a sense of scale, is 10 times what exists now. However, that pales in comparison to some of the other industries where you can have really substantial asset tokenization, such as real estate. There's $379 trillion of real estate in the world. There's another roughly 200 to 300 trillion in liquid bank deposits, bonds, and stocks. So people really have their eye on all these other assets, and they believe that the sort of overall growth room in that space is much, much larger, and hence the shift towards digital assets. I wouldn't say away from crypto, but people see it as a bigger prize.
I remember the hype around blockchain when it first kind of became a point of discussion here, and then subsequently the move into a lot of the cryptocurrency, the way in which blockchain was applied to crypto. It seems, though, lately the market is focused on anything related to artificial intelligence. Is there a lot of competition for new capital, let's say, that you're fighting for because of the current hype around AI?
There's definitely competition for capital. There's competition even more so for mind share, although there is also this integration that is going on. So there's probably three areas in particular where we see the most integration. First, using AI to develop crypto applications and crypto software. Secondly, using distributed computing systems built on cryptocurrency technology to handle the compute workload for AI. And then thirdly, kind of this idea that AI is for decision making and blockchain ecosystems for execution, that they can be very complementary together.
So Jamie Dimon says JP Morgan is one of the biggest users of blockchain. Yet he says we've been talking about blockchain for 12 years. Not much has happened. Is he wrong?
He's not entirely wrong. And I, for one, kind of really believe that the problem has been that we have not solved some of the critical issues for institutional enterprise users. One of them was regulation, right? So institutions just really can't use it that much without good regulation. And the second is a technological one, which is mostly privacy. So the industry has done an amazing job of solving the scalability problem, right? Where Ethereum used to be able to handle 1 million transactions a day. We can now do several hundred million a day through all these layer twos. The bigger problem has been that if you're an institution or an enterprise, you must have privacy technology. And it's really only just now that privacy systems like the architectures that we've been building and others have been working on are coming to the point where they are mature enough and scalable enough for businesses to use comfortably and without fear of kind of losing their sensitive data.
Paul Brody, thank you very much for joining us. Paul Brody, global blockchain leader at EY. He drives the EY initiatives and investments in blockchain technology.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.